The necessity of earning profit cannot be overemphasized. Without profit, it is impossible to attract creditors and investors. One profitability ratio is the profit margin on sales, which indicates the percentage of each dollar or peso of sales that results in profit. Please be well aware that the term profit margin here refers to the bottom line in the income statement, which is the net profit, not the gross profit nor the operating profit. In fact, profit margin on sales is also called net profit margin, net profit ratio, and net margin. Likewise, it is known by the name return on sales or simply profit margin or profit ratio, and even profit percentage. So many names referring to the same ratio. Just like how people call me by several names, aside from my real name and nickname, like handsome, good-looking, hot. Anyway, it will benefit you to keep in mind this early, that when we talk about financial ratios, every time you see the word return, it's net profit or net income that must come to your mind. Just like the other financial ratios we have already discussed, the name of this ratio gives us an idea about its formula. Net profit divided by net sales. As I just mentioned, the profit margin here refers to net profit, hence the numerator. As for the denominator, don't forget to use the net figure of the sales. For corporations with preference shares or preferred stock, instead of the net profit after deducting income tax, the numerator is the earnings or profit available for ordinary or common shareholders, which is actually the net profit after deducting the preference share dividends. For such corporations, these earnings available for ordinary or common shareholders is the bottom line in the income statement. As an aside, let me just point out that although dividends on preference shares are shown in the income statement, those dividends are not considered as expenses. Dividends are distributions of earnings or capital to the shareholders, not expenses. Anyway, so please remember that the profit or profit margin referred to in this ratio of profit margin on sales is always the profit after deducting all costs and expenses, including interest, taxes, and preferred share dividends or preference share dividends or preferred stock dividends, if any. No wonder this ratio is widely used as an entity's measure of the overall profitability of operations. For Elizabeth Materials Tailoring Store, the bottom line of its income statement is the net profit or net income amounting to 1,620,000. Its net sales figure, on the other hand, is 12,120,000. Hence, its profit margin on sales is 13.37%, which means that the net profit of the business is 13.37% of its net sales. Actually, we can also express our answer as 0.1337:1 and say that for every 1 peso of net sales, the entity earned net profit of about 13 centavos. To be more meaningful, this ratio for the year must be compared with that of previous years and with the ratio of competitors. Obviously, the higher this ratio, the more profitable the entity is. The nature of an entity's business should also be taken into consideration in determining the adequacy or inadequacy of the net profit ratio. A company which is engaged in a high-risk business or uses slow-moving assets that are costly to replace needs a very high net profit ratio. By the way, in case of net loss instead of net profit or net income, this ratio must appear with the negative sign. Also, in case you haven't realized yet, this profit margin on sales of 13.37% can be seen on the common size income statement of the business, which we did in the first part of this lecture series. Here. Because remember that in doing the vertical analysis on the income statement, each account or item here is expressed as a percentage of net sales. Hence, when we divided this net income of 1,620,000 by this net sales figure of 12,120,000, we got this 13.37%, which is the net profit ratio or profit margin on sales.